Today, we will talk about downside risk, definition, example, and how to calculate. Downside risk is an estimation of a security's potential loss in value if market conditions precipitate a decline in that security's price. Depending on the measure used, downside risk explains a worst-case scenario for an investment and indicates how much the investor stands to lose. Downside risk measures are considered one-sided tests since the potential for profit is not considered. Some investments have a finite amount of downside risk, while others have infinite risk. The purchase of a stock, for example, has a finite amount of downside risk bounded by zero. The investor can lose their entire investment, but not more. A short position in a stock, however, as accomplished through a short sale, entails unlimited downside risk since the price of the security could continue rising indefinitely. Similarly, being long an option, either a call or a put, has a downside risk limited to the price of the option's premium, while a naked short call option position has an unlimited potential downside risk because there is theoretically no limit to how far a stock can climb. Investors use a variety of technical and fundamental metrics to estimate the likelihood that an investment's value will decline, including historical performance and standard deviation calculations. With investments and portfolios, a very common downside risk measure is downside deviation, which is also known as semi-deviation. This measurement is a variation of standard deviation in that it measures the deviation of only bad volatility. It measures how large the deviation in losses is. The formula for downside deviation uses the same formula as standard deviation, but instead of using the average, it uses some return threshold. The risk-free rate is often used. Other downside risk measurements are sometimes employed by investors and analysts, including Roy's safety-first criterion, which evaluates portfolios based on the probability that their returns will fall below a minimum desired threshold. At an enterprise level, the most common downside risk measure is probably value at risk. VaR estimates how much a company and its portfolio of investments might lose with a given probability, given typical market conditions, during a set time period such as a day, week, or year. VaR is regularly employed by analysts and firms, as well as regulators in the financial industry, to estimate the total amount of assets needed to cover potential losses predicted at a certain probability. Here are 3 key takeaways. 1. Downside risk is a general term for the risk of a loss in an investment, as opposed to the symmetrical likelihood of a loss or gain. 2. Some investments have an infinite amount of downside risk, while others have limited downside risk. 3. Examples of downside risk calculations include semi-deviation, value at risk, VaR, and Roy's safety-first ratio. Hope this would help. Thanks for watching.